The hallmark of this rally since the beginning, since post-financial crisis, has been a rotation within the market. And Bob touched upon that at the beginning of the segment. That rotation is really healthy because that's the pause that refreshes and keeps us going. Rather than get a market correction, we get this internal dynamic that moves. And I think one of the areas that's been really underappreciated that changes with today's jobs report is the idea that inflation is very much underappreciated in this market. So the Fed is back on reflation watch today, and I think investors should be back on that reflation watch. But more importantly, it's an inexpensive trade. You can hedge with energy, you can hedge with the financials, which are moving up today. So the risk reward becomes very favorable because those are not the most expensive areas of the market today. And I think that's what's really critical, is moving away from what's expensive into what is less expensive, but has the potential to do better as market conditions change.
I agree completely with that.
What does the European Central Bank do? Because the real growth story here has not really been what's happening in the U.S., which has had low unemployment all along. It's been the transition that we've seen to the growth pickup in Europe.
Right.
So the European Central Bank takes a much more important role than the Fed. Look, the Fed is going to have to take action here, given the jobs report. We're going to have to see movement in the Fed. They're going to have to start changing their rhetoric. It's the European Central Bank that I think has been the surprise all year. Spain's going to grow more than the U.S. this year, and I think that's a whole different dynamic for investors. That's why money's been flowing overseas.
Project that out. Give me a year from now the relative difference between the ECB and the Fed. I would say it's still this big, and it's going to get maybe marginally tighter. I don't understand. If you're a bear on the U.S. at 93 on the DXY, were you so bullish at 102?
You know, today was a knee-jerk reaction because you've had the dollar sliding basically for 15 months, and you've had the lowest volatility in 20 years. But at the end of the day, we're seeing a lot more growth overseas. So investors have had enthusiasm for buying less expensive European stocks. The U.S. multinationals have really benefited from the weak dollar. That could change based on today's data as you see the dollar. We had a big move in the dollar
since we got to go in a moment here,
really
we know where Joe sits on the stock market. Larry, where do you think the right investments are right now? Does that mean you're sticking with the U.S.? You're kind of comfortable with the sector rotation that we continue to see? I mean, what's the idea here?
You've got to follow that rotation, and you've got to focus moving out of some of the more expensive areas. There's a lot of defensive areas that have been left behind. Look at the anti-Amazon trade, something like General Mills today, which has been left behind. Food stocks, very defensive, high yields. There's lots of special situations. We talked about the reflation trade, and I think the global economy looks a lot better. There's a lot of opportunities. You have to be very valuation conscious where this market is today, though.